Hey, all right. Good morning, everybody. So we made it through the ADP. Um, without the market maker move indicating the additional hedge, really had that sneaky suspicion yesterday that we weren't done with the hurry up and wait after all. We didn't see the move we were looking for. They weren't hedging for it. So it left us without another big move day. We are still iX-10. Sooner or later, right? Sooner or later. So we can see Japan down a half, small caps basically flat with Hong Kong. The Nasdaq at zero, and the S&P barely up. Now the S&P and the Dow kind of tugging neck to neck, and the Nasdaq dragging its feet a little bit. It's a bit of a tell, right? A lot of mornings it's been either small caps leading in the overnight and then taking a back seat while the Nasdaq drives, or it's been the Nasdaq leading. Um, Probably 45 minutes ago, an hour ago, seen IWM break the range first, start heading south, but we're still just hold up iX-10, waiting it out. It's worth really considering the numbers that we got yesterday on the ADP. The forecast, depending on where you were at, everywhere that I looked, it was a positive forecast. 40, 32, 22, depending on different places, but they were all positive. And look how negative it ended up being. And consider that. Consider how far away they were in their numbers. Just absolutely missed, right? It's not like they missed a little bit. They missed by a radical margin, and the market didn't care at all. None. So it really highlights that whatever hurry up and wait mode we began the week with, we're still in it. We have not gotten whatever it is the market is waiting on. So that leaves us with today. There's also something missing here, right? Where's non-farm payrolls at? It's employment week. We're getting employment data every day this week. That's generally how it works. Where's non-farm payrolls? So we're going to get European Central Bank Speaker Lane today at 11 o'clock. We got auctions this afternoon. By 1 o'clock, we should be good. I don't think this European Central Bank speaker has much to offer. Of course, there's always a threat, right? You can dig deeper into it, see where they're speaking, and see if there's going to be any Q&A, or see if it's a pre-recorded message, something like that, because that can eliminate risk. If it's pre-recorded, no Q&A, very unlikely that whatever the speech is going to be impactful. This looks like it's a awards ceremony. So unless they go asking him questions, it's very unlikely that he can screw anything up or be misquoted, or get in a gotcha situation. So I doubt that one has any bearing on our afternoon, which means once we're done with Bowman, then we should be good. And that one doesn't even look like it's much of a threat either. It's going to be a virtual meeting, and it's a luncheon. Very likely no Q&A, no gotcha. The 4-week auction, it's all right up in the front. You could use like IRX monitor on that one. Very likely not going to have any impact of note. So once we are through with the morning shenanigans, we should be good to go. Bad news continues to be good news at this point. All right, we can see CTA positioning is still lagging the broader market. This is Mentor Q compared to, say, Gamma Lab and its CTA positioning. I should have brought it up, had it ready. They're both showing the same thing, just from a different starting point. Like this is mostly the 2025 year, so it's a real zoomed in view from a Gamma Lab, and this is a broader perspective all the way back to the start of 2024. So it's capturing, a full 2 years nearly. So we can see they're adding back in a little bit, putting risk into their portfolio, but they're nowhere near back to the previous high, and yet price is close to getting back to that previous high. It's a lot to consider, their allocation size. They were a bit exuberant, right? Maybe a little too heavily invested in the crowded trade, and dialing it back to a more reasonable allocation makes sense. I don't see this pullback in the CTA as a negative necessarily. I see it as becoming more reasonable. Could be a buy the dip opportunity on Apple. It's down because one of their top designers is leaving. Meta poached another employee. It seems like Meta has a lot of Apple employees at this point. It doesn't look like the president has a lot of public stuff going on. They're going to greet leaders from other nations. Looks like Rwanda and the Congo Republic. And they're going to light the Christmas tree today. Probably not a big deal, yeah, when it comes to impacting the market, but who knows? Maybe they'll use the wrong color on the Christmas tree lights and everybody will freak out. I don't know. Overnight volume at around 50. It seems light, but I mean that's our normal level of volume. We've been kind of running a little hot especially at this time of year. So it's just dialed back into what we would consider to be a more normalized level of volume. We are still iX-10, as I mentioned. It just means that we're inside day of an inside day of an inside day at this point. Now, a lot of analysts get picky when it comes to iX-10s. I don't. Not a game of perfect. There's no reason to become some Canadian engineer at this point. This is the range that we want to focus on. I overshot it. It's the red one here, just so that the line's easier to see. It's that red day. Now, this morning, we're pushing and we're getting outside of this box again, but we were iX-10 earlier. And if we fall back down below yesterday's close, then we will be back inside the range again. At the moment, we happen to be peaking outside of it like we did yesterday. You see this peak outside here. The white line is the 3-period moving average. If I zoom out a little bit, you can see we've got that fork pattern going on, 20, 10, 3, spread out nicely. Price maintaining itself above the 3. We had talked about how we had run really fast, started to get a little hot back here, and we got too far away from that 3 period. We needed to pause. So we went sideways, let the 3 get caught up with us. That's a correction in time. And now that it has caught up with us, it's time to either break under it and begin the trip back down, or push off of it and begin that move higher. At the moment, we are on the upper edge of the iX-10 and pushing higher, but we need to do the thing, right? This is the way it is. Got to get it done. If we've failed there and we come back in, it's not necessarily a failure until we get outside of the iX-10 on the other side. Now, me, I don't like to short from the hole. I don't like to buy from the highs. It's just the way it is, right? So you do you. We're just talking analysis here. The short isn't a valid short with signals until you've got signals that tell you the short is on. That can be 50% of the range, say a half back break, cutting the 3, or getting outside of the iX-10 on the downside down there. Just kind of move that over so we can see the wick. There's an old market phrase that talks about how the body of candles is where the traders were working, and the wicks of candles is where stops were triggered. It's an old phrase, it's an old concept, but it does kind of, lend some value when you're gauging what markets are doing on different time frames. We are where traders stopped out yesterday. It's one way to look at it, right? We're in this zone, this wick area. So we need to get through that. When it comes to yesterday, if we break yesterday's close, we get through that 4-period daily moving average. We get underneath the half, that's 68.50. Then the half. Then yesterday's RTH open, or yesterday's open, and then on down, get to the 10, cut that, get to the 20. We got cog lines down here. We've got the big round number down here. There's a lot of levels underneath this to really help us out. But if we start looking the other way around, if this level holds and we push off of it, then 6,900 and 6,950 are what's on the road looking higher. We are running a bit of a zipper program this morning. It's not a pattern you're ever going to hear about in the textbooks. I'm a big fan of reciprocation, of what you get on one side of the range, you get on the other. Reciprocation works on things like MACD, RSI, stochastics, price action like VWAP. Whatever you get on one side, you get on the other side. When you start to identify a zipper situation and reciprocation situation, then you can start measuring out and plotting and identifying what you're working with. So that's what we had going on. Now it looks like we're breaking it. Going to depend on what we do up here, if we're able to get through this or not. If that fails, run it back to VWAP. If VWAP fails, test this low. If that fails, then test the low down here. We're still looking for that range right there. This is our range until something breaks. It's about 15 to 20 points, 68.55 to 68.70-ish. Just running back and forth in this range until something breaks. Okay. Underneath the 4-day, we've got the half back of yesterday. So we can see the levels nice and clear. All we got to do is do it. Still no hedging this morning. The two red lines that you see are the ADR half. It is what the market has been doing on average for the last month. Think about it, a whole month. If every day the same thing happens over and over and over again for 20 days in a row, what do you think happens on day 21? Right? What the base case argument is, yeah, we'll probably do what we did yesterday. It's kind of the routine at this point. Well, the routine move is around 100 points. We can split that 100 points in half, go 50 to the upside, 50 to the downside, just kind of working our way in between those two levels. And that'd be just another day at the office. If we happen to move in a single direction, if we get bullish today and we want to move the entire average in one direction, that'd be the yellow lines. So if we get bullish, 69, 64, and if we get bearish, 67, 67. We're basically flat at this point. So there's no edge in trying to guess which direction we're going to go. We've got to get out of the box, and whichever side we finally get out of the box, that'll be the direction we want to cut. We've been in hurry up and wait mode all week. And the expectation, at least my expectation, was that it was probably the ADP. But we made it through that, and it wasn't that, and we're still in this hurry up and wait mode. So I don't know. Keep your eye on the market maker move, because if it's such a big deal, they'll begin to hedge in front of it, whatever it happens to be. It's one of the good things about running the tools the way that we do. Even if you don't know what the event is, if we get close enough to the event that they start to react to it, we'll see the reaction. Today's floor pivot is higher than yesterday's. That's bullish. Price opened above it. That's bullish. We tried to hit it and stayed above it anyways, and that's bullish. We just kind of stack them on top of each other. Today's floor pivot is basically the 68.50 level, not to the tick perfect, but it's close enough. And we have a MDP, that's a missed daily pivot. This purple line is our daily floor pivot. and we haven't hit it yet, which makes it a missed daily pivot. The thing is, it doesn't count today because at any point today, we could go down and hit it, and then, well, it wouldn't be a missed daily pivot anymore. So tomorrow, if we look back and we still haven't hit it, then we'll count it and we'll say it was a missed daily pivot. Having gotten inside of the channel and failing to hit that pivot, staying bullish enough or getting bid back up in a timely way to avoid that pivot really implies that we need to keep it. If we were to go back down inside of this channel and hit that pivot, it's more likely we're going to break it also. But we could get a first touch play. Yesterday's midpoint is the bottom of that channel, which lines up really nice for our analysis. If we break the floor pivot, we want to check the low, and breaking that low is breaking yesterday's mid. We would target yesterday's low. Level by level, baby, just run it all the way back down. All right, we got a really nice distribution out on the higher time frame, classic D shape. We left behind the point of control well. From this elevation, we really can't see how these highs were treated, right? Looking at the volume, comparing it to the price action, we don't really see any um, significant participation from this elevation. We'd have to go to a smaller time frame. But looking at what we've been doing for the week, we've been sideways, putting in a lot of work in the middle of the range. Think about that, right? We've been in this range all week. And the discussion about ranges is nobody knows you're wrong until you leave the range, right? So shorts can pile in that range like crazy. Longs can get in. Everybody's got a bias and an opinion and putting money on the line. And nobody knows if they're going to be right or wrong until we get the hell out of the box. Most of the traders that have been piling into this range, most of the trades and the volume has been nearly in the middle of the range. Really? Me, I like to trade from the edges. I don't know. Maybe we need to reevaluate our approach. I'm not going to do that, but can't can't deny that's where the bulk of the trading has taken place. Ten-day, 30-minute volume profile and TPO. The volume side of this is just an ugly, disgusting mess. The TPO is a little bit cleaner, but still not like a classic P shape. Can't even get like a classic double D shape out of that. There's just these odd distributions in weird places that don't line up with options levels or big round numbers or anything like that. Still, we got our zone in place. We've brought the point of control up to us into this iX-10, and that becomes a significant structure now. The point of control itself isn't support or resistance. It's more like gravity at this point, safety zone. So as long as we're hanging out in this range, we can cross back and forth as much as we want. When we finally leave the range, and then we attempt to come back towards that line, it would very likely begin to act as a support or resistance, depending on if we was above it or below it. But we would need to leave the range and then come back to challenge it. We are above it. We've been working it out here and having it brought up to us here. We've got the 4, we've got the point of control, we've got the hurry up and wait, and the catalyst and the construction and compression of the iX-10. This market is ready to pop up. Now, it doesn't have to go up, right? That up is my bias, but it doesn't have to go up. One thing's for certain. We're wound up. We're ready to go. A big move is coming. And it's going to go either up or down, right? A little bit of Captain Obvious there. We can't stay here. We're going to go one way or the other, and it's coming soon. So you can use that to your advantage. I know it doesn't sound like it's very helpful, but really cheap calls way out of the money, or really cheap puts way out of the money, something honestly cheap, right? Like gas station lottery cheap. Something so cheap that if it loses, you just kind of shrug and say, whatever, I don't care. It's $2, 2 pennies, you know, whatever. Don't put a lot of risk in it. This isn't one of those trades you want to pile in with half your portfolio and diamond hand the darn thing. You could run something a little more strategic, strangle, straddle, but there's no need. And if you want to, do anything more than just a really cheap call or a put, then butterflies would be the way to go. Because butterflies, especially a out of the money butterfly, you could get it 30, 40, 50 points wide. If you're far enough out of the money, it's still going to be dirt cheap. Low risk. So a big move is coming. I think we're going to go up, but it doesn't matter which way. You can just see that we're going to make a break. We are back above Friday's close. We closed above Friday's close yesterday. So this is a continuation of the rebound of yesterday. Think about how we would have been positioned if that Microsoft headline hadn't knocked us down. Because really all we've done is get back to where we were before the Microsoft headline, which got revised anyways, right? The publication called Information was the one who had come out and said that Microsoft had downgraded their quota targets or some language like that. Then they got a talking to, maybe their hand slapped, and they came out with a revision that said in-house Microsoft was adjusting its quotas, but I don't know. They changed the language of the post, and I know it all seemed like lawyers arguing semantics, but we rallied back up to where we were. Like yesterday never happened, and now here we are. But we're still waiting on something because we're iX-10, and we've been in hurry up and wait mode all week. It's unusual to have a hurry up and wait mode last more than 2 days. Usually it's Monday, Tuesday, and then bang into Wednesday, or it's Tuesday, Wednesday, and bang into Thursday. It's very rare to have Monday, Tuesday, Wednesday looking for a Thursday move. And almost unheard of to be sideways all week waiting for the Friday move. Can't remember the last time we did a 4-day wait. With that obvious sideways structure, we are, of course, not overbought. We're not overextended. We haven't moved too far, too fast, because we haven't gone anywhere. Doesn't matter if it's the daily or the weekly, we're not extended because we haven't done anything. There's been some talk of growth versus value rotations and how staples are a better vehicle in a rate cutting regime. And, it's certainly something to think about. Um, the white lines that you see on each of these charts is a Linreg line. And you can see that utilities, which is in the bottom right here, looks a lot like our risk on levels because, well, utilities is basically tied to data centers at this point, which makes it the AI trade and no longer a quote staple or a flight to safety sector. And then we've got our industrials and building materials and that sort of stuff and energy here in the middle. And I mean, energy and building materials are basically flatline. Industrials look good, but again, they're tied to the build out. So that just leaves healthcare and staples down here. Now, healthcare, sharp turnaround. They pulled that 50 through, and beautiful maneuver. Look at that aggressive turn in the 50. That's a really sharp turn for an ETF that isn't supposed to move around that much. This is supposed to be sleepy and boring. That doesn't look sleepy and boring to me. So we're turning it around. There's a lot that needs to be done here. Look for a little more weakness in healthcare. See if we can get a reset back to like 50, maybe 52, but I think 52 might be a little squishy. So 50. At some point, we are going to get underneath that 50, but we turned it around and we pulled the 50 through the 200. Staples, on the other hand, we're still underneath the 200, and it's a downsloping 200. So if we are going to start that capital rotation, right, in a growth value space, there's a lot to do. There's probably a lot of names on that list worth taking a look at. Looking at what's down this morning, gold miners are down. The Mag 7 down volume is down, and yes, that is a double negative. Chips, bonds, Bitcoin, but not enough, right? We need a lot more out of chips, bonds, and Bitcoin for them to be considered down. We need 0.5%, and they're not down that much. So look to see if they continue that weakness and get worse, or if they hold the line. Being down in the pre-market's not necessarily a bad thing, right? All things considered. You want that gap down. If you've had a market that's been going up, you want that pullback for the next run up, right? That's what you want. So being down in the pre-market is not necessarily a bad thing, especially if you're at the highs. You want a down move first before a move up. And if you look at this range, we had the run up, and then we've been sitting here digesting that run. So yes, we got to get out of the box, but we've got to also finish correcting from that move. The Mag 7 is up with China, but not enough on either one of those. We need 0.5% on the upside too, and we don't have it. So a lot of China up this morning. The Mag 7 up volume is up, and it's up enough, more than 0.5%. So when we get in today to the market, we want to keep our eye on the cumulative volume and the advancing and declining issues. If you got think or swim, that's pretty easy, right? Because you got the visualize tab. Change the heat map out for the index watch, and then just choose your index. Now these stack really nice because you can just make them into tiny little footprints. That way, you know, they don't take up much space, and you can make sure they don't fall behind. So you can set up, you know, like the S&P. And you can do one for the NASDAQ. You can make your own little ETF if you want, something like the MAG7, and turn that into an index. So you've got the advancing and declining issues. You've also got the money flow, and then you've got the volume. Really nice way to keep track of things on the day. If we're going to get that breakout to the upside or the downside, it's very likely going to be a rising tide that lifts all boats, or a massive tsunami of selling where everybody's chasing the exit. One or the other, right? So it should not be subtle or sneaky or gotcha. It should just be an overwhelming force. Should easily be able to see it in the flows. The question is, will we see it in the flows before we finally get the breakout? Because then we could position for the move before the move comes, and I would like to do that rather than chase it. So keep your eye on the flows today. See if we start to get that swell or rising tide, so we can position for the move. Especially since we're still sitting here wondering, which economic event are we waiting on? We got the VIX at $16. That is well inside the range that says the broader market's pullback is just that, just a pullback. We're not in correction territory. We're not in a violent mode. So if things start to get ugly today, look for the VIX to push back up through 17.5 and get into that 18, 19 area. That would be a break above the 10 and the 20-day moving average. Oh, excuse me, an hourly moving average. On the daily, we'd have to get through 18 to get through that 10. That 10-day is going to be a little rougher to get through. If we break down through 15, well, let's just call it 16. If we get underneath 16, then 15 is our focus. So far today, pot stocks are leading the way. You don't want a rally day on pot stocks. We really need to see the MAG7 come in here and take control of this situation if we're going to look for a rally to the upside. So we can see MAGs are up. They're 0.4. That's not enough. We need more out of it. And having supportive roles with that, like financials, consumer discretionary, communications, chips, anything like that, right? Cloud computing, something. All right, everybody, the range is set, clear. It's pretty simple at this point. Get out of the box of our own Globex range to either break out on the week and run to the upside, or break yesterday's mid to check yesterday's low, then check the low of the week and the weekly floor pivot, and we'll begin the expansion to the downside. Either one. That's what I got for you guys. Be careful, be safe, watch the clock. keep your eye on the flows. I'll see y'all tomorrow.